Introduction to Control Accounts. We are learning how to prepare Sales Ledger Control Account, which could be known as Account Receivable or Trade Receivable Ledger, and the Purchases Ledger Control Account, which could be known as Accounts Payable or Trade Payable Ledger. Lecture number 1 for Controlling Accounts Introduction. Control accounts are also known as total accounts. If the trial balance fails to balance and the error cannot be readily located, it is necessary to check all the accounting records. This can take a considerable amount of time. The checking process can be speed up if a control account for the sales ledger, which contains the accounts of debtors, and a control account for the purchases ledger, which contains the account of the creditors, have been prepared. These accounts act as a check on the individual accounts within these ledgers. Like the trial balance, however, these accounts can only be checked the arithmetical accuracy. Errors such as omission and commission will not be revealed by a control account. So we can say that the control accounts are a helping tool in detecting the errors of accounts records. We use mostly sales ledger control account and purchases ledger control account. Sales ledger control account, also known as total debtors account. This account resembles the account of a debtor, but instead of containing transactions concerned with just one person or business, it contains transactions relating to all the debtors. A typical sales ledger control account appears as follows. The opening balance debit will come here. The opening balance credit will come here. How could one ledger account have the opening balances in both sides, debit and credit, at the same time? We will discuss the point in the next slides. This sales ledger control account will be debited if we make a credit sale. It means an increase in credit sale or the increase in trade receivable will debit this account. If our credit customers are refunding us the goods, then again this account will be debited. If the goods are being returned by our customers, that means we have sales return, it will decrease the control account of sales, or you can say the trade receivable will be decreased, therefore it should be recorded in a credit side. If our customers are making us payment, we are receiving money from them, the trade receivable ledger or sales ledger will decrease. If discount is given by us to our customers, again the trade receivable or the sales ledger will decrease, therefore it will come in the credit side. If we are recording the bad debts as write-off, it means we will not be receiving these trade receivables anymore, we will be crediting them. The balance carried down and the balance brought down for both the debit and credit side will be mentioned before these totals, and then we'll be totaling the account and ruling it off. Contra entries in control accounts are also very important. These are also known as inter-ledger transfers or set-offs. What does this mean? It may happen that a business sells goods to another business and also buys different goods from that business. This means that there will be two ledger accounts for the same business. For example, if I purchase goods from Mr. Ali and I sell the goods to Mr. Ali at the same time, if I deal in two types of goods and Mr. Ali also deal in multiple types of goods, one type of good is sold by me to Mr. Ali and the other type of good is purchased by me from Mr. Ali. In that case, I'll have the sales and purchases ledger of Mr. Ali at the same time. The important note is, rather than each business sending the others to cover the amount due, they may agree to set one account of another. Any remaining amount will be settled by the business balances. Same is the case with the balances on both sides of control accounts. Occasionally, a debtor's account may show a credit balance. This may occur due to the following factors: an overpayment by the debtor, the debtor returning goods after paying the account, the debtor paying in advance for the goods, cash discount not being deducted before payment was made. In the sales ledger control account, it is usual to keep any credit balance separate from the debit balance. The control account will therefore have two balances. The usual debit balance representing money owing by debtors and the more unusual credit balance representing money owing to debtors due to any of these reasons. Any credit balance is entered on the debit side of the control account and carried down as a credit balance. The account can then be balanced in the usual way. This is how the balances on both sides of a control account may take place. Let's see the other important purchases ledger control account, which can also be referred to as the total creditors account or the payables account. This account resembles the account of a creditor, but instead of containing transactions concerned with just one person or business, it contains transactions relating to all the creditors. A typical purchases ledger control account appears as follows. The balance will come in the credit side. If we have both the balances, debit and credit, then they will be entered on both sides. Purchases ledger, which is also known as trade payable, if we are paying the money to our supplier, this account will be decreased or debited. If we are returning goods to the supplier, then again this account will be decreased or debited. If discount is given by the supplier to us, we are receiving discount. This trade payable account will be debited. If we are purchasing goods on credit, it will increase the payables as a liability and it will be credited. Remember, purchases ledger account is also assumed as the trade payable ledger account. In the end, the debits and credits will be differentiated. We'll subtract them and we'll write the balance carried down or the brought down on the side which it belongs to. If we have both the balances, they'll be written in the usual manner. Like, share, subscribe. Commerce Lecture Online.